First, our talk of the tape. Have markets fully sidestepped the seasonal pre-election weakness we were promised? Has the tenacious rally made investors a bit too optimistic by now, or are the bull market fundamentals just that good? Here to discuss all of it are Gabriela Santos, JPMorgan global market strategist, and Ankur Crawford, portfolio manager at Alger. Thank you very much for both being here. It's pretty hard to find too much fault, Gabriela, with how the market's behaving in terms of cyclical leadership and, banks being rewarded for good numbers. Now you have small caps, the average stock working. It really sends a pretty good macro message. And I guess the question is, we felt like this before. We've had growth scares that followed this. So how do you think the setup is going into earnings season at a high?
I think we need to clarify what we mean by a good economy. And what we mean in terms of how we should express that in the stock market. So in terms of the economy, it's doing fine. But at the margin, we do see some deceleration, some normalization in growth rates. And this is especially true in the consumer. Still doing good enough, but we have to be careful to translate that into actual earnings expectations for things like consumer discretionary, consumer staples, even some travel and leisure, where you're seeing some normalization. But what we heard from banks, and so far a great start to the earnings season, is that good enough, normal kind of consumer that keeps the overall economy on track. We would just prefer to still express that via higher quality companies. So, for example, large caps over small caps, and some sectors that also have not just a cyclical tailwind, but also have more structural tailwinds. And here, thinking of healthcare and industrials.
Is that because, in part, you think that this earnings revival that we're expected to see in the broader list of stocks is either priced in or not likely to come around, or we're still on watch for that weakening of the broader economy?
I think it's mostly there are two stories happening in earnings right now, and we've had very divergent stories for a few years now. There's the decelerating but great result out of mega cap tech with high expectations, so very jittery there. And then we have the entire rest of the market, which is, it seems, finally coming from an earnings recession. Now, I think in terms of the growth rate, what we expect, there are some risks around two issues. The first is nominal growth normalizing or decelerating, which companies are actually going to be able to keep pretty good revenues, and then margins. Margins last season gave a little bit of conviction that they seem to be troughing for the first time in 2-3 years, but which companies exactly can still maintain margins? So I don't think it's a broad cyclicals, low quality kind of earnings or kind of macro environment.
Yeah, it seems like it has to be kind of execution gets rewarded. We'll see if that does come to pass. Ankur, talk about tale of two or more, stories here within growth. And within the big themes that you would focus on, the market has really differentiated among some. I mean, just in the near term. Microsoft's been sideways for months now. Obviously, NVIDIA pushing the highs, but also hasn't made one since June. But then you have Meta and these other names that really are in favor. So how do you think the sort of broader landscape shapes up at the moment?
Yeah, so I think what you're seeing is a bifurcation in those companies that are able to generate revenues from AI here and now, versus those that are having to spend in order to get AI revenues at some point in the future. And the market is losing a little bit of patience with the companies like Amazon or Microsoft for the likes of NVIDIA and Meta. And so I think as you go across all sectors, you're seeing this massive bifurcation in the AI beneficiaries versus not. Even yesterday, ASML was plagued with a whole slew of their own issues and has become kind of a big laggard relative to the AI beneficiaries along with the rest of semi-cap equipment. And so you're just starting to see this breaking of correlations inside of sectors, which I find is great for us as we're stock pickers, but it makes for a challenging market. Yeah,
I would say challenging, but arguably also healthier because everyone was complaining when these stocks were treated as just sort of one big block and very, very broad and thematic. When it comes, though, to something like Microsoft, I mean, it's funny because it seems as if that stock was really given credit up front for having a monetization strategy for AI. You were getting subscriptions per seat and all the rest. Why is it now not viewed quite that way?
I think as the CapEx cycle is coming to unfold, I mean, our belief is, and last time I was on the show, we talked about how CapEx is going to grow in 25, 26, 27, and 28 for all of these hyperscalers. the market is starting to digest that because it does take from your free cash flow. Now, I would argue that, this happened in the early years of cloud, 10, 15 years ago. And aren't we glad that they spent that way on cloud, 1.5 decades ago? So we're seeing the same kind of cycle today where the revenues are going to come. They'll just come at a slower rate. Now, Microsoft assures us that they will come with a high ROI. So whatever expenditure they will make, there will be an almost immediate ROI. So let's see as they go through the next year.